Welcome, everyone. We'll give everyone just a few minutes to join, and then we'll get started. Right, it looks like everyone is trickling in, but we'll go ahead and get started now. Good afternoon, everyone, and welcome to the GHA's webcast on the new accounting standard for credit losses for financial instruments. My name is Yulia Murzaeva, and I'm a principal at GHA's audit practice responsible for quality control initiatives, and I will be your moderator today. Before we get started, we have a few household items to go over. First of all, if you would like to receive CPE credit for today's event, please be sure to respond to all polling questions. There will be a total of 3, and stay on for the duration of the hour. Next, if you have any questions about the standard, please feel free to drop them in the Q&A box, and we will try to get to them at the end of the hour. Finally, the webcast today will be recorded, and the link to the recording as well as the webcast materials will be sent to all participants after the event. And now, with the administrative items out of the way, let's turn to the webcast agenda. We do have quite a packed agenda today, with the goal of hopefully providing an overview for you for the current expected credit loss standard, or CECL, as it's most commonly called. So we'll give you an overview of the standard and let you know how it may impact your company or organization. We'll get into the specifics on how to perform that analysis to estimate credit losses for different types of financial instruments that you may have, such as cash equivalents, trade receivables, held-to-maturity debt securities, and others. We'll also cover some of the financial statement implications, and we'll also go over what management will need to do to help prepare for the standard. It is now my pleasure to introduce your speakers for the event and our GHA experts on the CECL standard, Elad Mena and Cindy Bischoff. Elad is a senior manager with our GHA's audit practice. He works primarily on food and beverage clients as well as manufacturing and distribution clients. And Elad leads a number of our technical resource groups at the firm. And most recently, he has led the implementation task force for the new lease standard. Cindy is a manager with our audit practice as well, and she works in both for-profit and non-profit entities, including private foundations, which gives her a unique perspective on the standard. Both Elad and Cindy spent a lot of time over the past several months or close to several years now, looking at the guidance, researching that, looking at the potential implications of the standard, developing resources, toolkits to help implement the standard, and providing internal and external trainings. So you're in great hands today. We thought we'd get started with a quick background on the standard. So you might be wondering why we're talking about the CECL today. The standard itself has been issued in 2016, and it's now finally effective for private companies, nonprofits, and employee benefit plans with fiscal year ends beginning after December 15, 2022. So these are my calendar year 2023 entities and onward. And why do we have another new accounting standard? Well, historically, as you might remember, we have been accounting for bad debts or credit losses using the incurred loss approach. That meant that bad debts were only recognized when it was probable that the loss would be incurred. And so in the financial crisis of 2007-2008, it became fairly clear that there were inherent weaknesses with this approach, as many financial institutions and other entities have been carrying impaired assets on their books, but were not recognizing credit losses on those assets because they didn't meet the requirements for accounting based on accounting guidance. And so in the midst of the crisis, the FASB formed a collaborative task force with the International Accounting Standards Board in 2008. The task force was called the Financial Crisis Advisory Group. And as a result of that collaboration, a new accounting standard was born, CECL. And really what it brought or what it changed is that when accounting for credit losses, we are now not only looking at historical loss information, but we're also taking into account some forward-looking trends. And so now that you have a little preview of the standard, I'll turn it over to Elad to get us started on a detailed overview. Elad?
Thank you, Yulia. I appreciate the introduction. So let's get started with an overview of CECL. So CECL falls under topic 326, and it is divided into two subtopics, 326-20 and 326-30, each which contains a different credit loss model. Now, the FASB decided that available for sale debt securities require its own separate credit loss model in subtopic 30. And the reason being is that the CECL model in subtopic 20 is designed to estimate credit losses over the contractual life of the asset. And so the FASB decided that this model may not be suitable for financial assets that an entity may not intend to hold until maturity. Now, since available for sale debt securities are less common, we won't be covering them in much detail during this presentation. However, for those who do hold such investments, please be advised that amendments have been made to Legacy GAAP for available for sale debt securities. Now, on to the main subtopic, subtopic 20. It houses the main CECL model that applies to several different types of assets, which you can see here on this slide. The webinar today will provide an overview of the main CECL model and the most common financial instruments to which it applies. For example, trade accounts receivable, which is going to be the most common financial asset in scope for privately held companies. In addition, we have loans and notes receivable, cash equivalents, held to maturity debt securities, net investments and finance leases that are also considered more of the common in scope assets. That being said, there are also less common financial instruments in scope, such as off-balance sheet credit exposures and reinsurance receivables. We also have programmatic loans, which fall under scope, and these are the type of loans that are typically made by private foundations. As you can see, there is a wide variety of financial assets that are in scope, but the allowance for credit losses is determined using the same credit loss model under the subtopic 326-20. So with that being said, we'll move on to the next slide. We've covered what's in scope, so now let's cover what's out of scope. There are some noteworthy exceptions, and we'll go through them right now. Financial assets measured at fair value through net income are pretty much the largest group of assets that fall outside the scope of the standard. And these include investments that fall under the fair value hierarchy under ASC 820. So that's your level 1, your level 2, your level 3, and investments held at net asset values. Now I can almost hear, I know everyone's on mute, but I could hear the sigh of relief from my nonprofit viewers today. In addition, for the non-for-profit companies, promises to give and pledges receivable are also out of scope with respect to CECL. Now, before we get into privately held companies and corporations, another niche-specific out-of-scope item includes participant loans under employee benefit plans. So, other common items that are outside of scope that may be relevant to both corporations and organizations include debt securities categorized as trading. Now, this is opposed to the debt securities that are held to maturity, which we will discuss later in this presentation. Loans and receivables between entities under common control, and receivables arising from operating leases for lessors under the new lease standards. Now, keep in mind that finance lease receivables or net investment in leases under ASC 842 actually do fall within the scope of CECL. So we chatted a bit about what falls outside of scope for nonprofit entities. But there are important items that we must not lose sight of. And these are the financial assets that fall within the scope that relate to nonprofits. And these are the assets that are derived from exchange transactions under ASC 606 and commonly include some items listed on this slide, such as tuition income, program fee income, membership dues, registration fees, and patient receivables for nonprofit healthcare entities. Those are the ones that fall within the scope. So if you're a nonprofit and you have exchange transactions, any receivables that arrive from those transactions fall within scope of CECL. Now let's talk about some easy things. So before we dive into the new credit loss standard, I'd like to point out some of the new terminology that the standard uses. Now, bad debt expense is now phrased as credit loss expense in the new standard. And the allowance for doubtful accounts is now called the allowance for credit loss, which you'll sometimes see abbreviated as ACL. Now, there's no rule against using the old-fashioned terms, but these new terms are favored under the new standards. So why not illustrate that we know what we are doing and that we are up to date with the new lingo? And that being said, it's also worthwhile to note that we have reviewed dozens of publicly traded financial statements, and publicly traded companies were actually already required to adopt the standards before privately held companies. And what we can say is that all these companies have used the updated terminology while adopting CECL. So what are the key changes between legacy GAAP and the current model under CECL? And these are actually illustrated in this slide. But under the previous model, which was called the incurred loss model, a loss would be recorded when the probable threshold for a loss had been met or when it had been incurred as of the balance sheet date. This typically resulted in trade receivables that are either current or not yet due, having no reserves set against them. Under the new CECL model, an allowance for expected credit losses will have to be considered for these items. The CECL model requires entities to estimate and recognize all expected credit losses over the contractual terms for financial assets in scope immediately, even if the risk of loss is remote, which would include receivables that are not past due. Another big difference is that under the previous model, pooling was allowed, but not necessarily required. Now it is required under the new standard. What is pooling? Pooling involves segregating subpopulations by certain risk characteristics. For example, if we have receivables from business-to-business transactions versus business-to-consumer transactions, we may want to bifurcate the two separately. Similarly, if we have foreign versus domestic partners, we might want to consider those subpopulations separately. And in terms of investments, we can look at corporate bonds, municipal bonds, and federal securities separately. And the reason for that is that these different subpopulations may have or possess different risk characteristics that will result in different factors being used to calculate the expected credit loss for those specific assets. Now, lastly, under the previous model, only current economic conditions were considered, whereas under CECL, both current economic conditions as well as management's reasonable and supportable forecasts of future economic conditions are to be considered. So this illustration right here encompasses the basic flow of considerations under the CECL model. The estimate of expected credit losses is based on relevant information about past events, current economic conditions, and reasonable and supportable forecasts for future economic conditions that affect the collectibility of the reported amounts. Historical loss experience is generally the starting point for estimating expected credit losses, but then we develop a loss rate from those historical events, which we adjust to reflect differences between current conditions and past conditions, along with reasonable and supportable macroeconomic forecasts. With respect to future considerations, examples from the standards describe entities selecting macroeconomic variables such as unemployment rates, interest rates, inflation, or other factors that may be relevant to the entity's ability to collect off of their financial assets. And that may include property values per se, if we're dealing with real estate companies. So based on these factors, adjustment can be made to the allowance for credit losses, either quantitatively or qualitatively. Now, we've reviewed this for many of our clients already, and we actually find that a qualitative adjustment is the most practical approach to assessing the impact of future economic conditions on the allowance for credit losses. And Cindy will actually go over that in the following slides. Now, with all that said, if the risk characteristics of the financial assets are consistent over time, then it could be that there is no adjustment to the historical loss rate based on historical experience, but that does not necessarily preclude us from making those considerations. So we know that the historical losses generally provide a good starting point for calculating the expected credit loss, and there's not much judgment that we need to make in that case. But next, we're required to pool assets and incorporate forward-looking information. Now, how we do that is actually quite judgmental. So remember, CECL is a principle-based standard, and we're relying on management's judgment to implement the model. There's guidance in the standard, but no prescribed method for how to execute these considerations. The standard requires a high degree of management judgment, which also includes which model for calculated estimated losses should be used. Now, we will also be discussing these available models in the following slides. And with that, I'll transition over to Cindy to get us started on cash equivalents.
Thank you, Elad. Hello, everyone. Thank you again for being here with us today to learn about the new credit loss standard. So cash equivalents are measured at amortized costs and are in scope for CECL. So this would include assets such as treasury bills, money markets, CDs, and the standard specifically notes that no measure of credit loss is required for a financial asset or group of financial assets if historical credit loss information adjusted for current conditions and reasonable and supportable forecasts results in an expectation that non-payment of the amortized cost basis is zero. So management will need to do an analysis, but in some cases, management may determine that the expected losses approximate zero, and therefore no allowance for credit loss is necessary. So there's a specific example of this in the standard that I'll walk you through now, where an entity is invested in U.S. Treasury securities. So in this example, management performs a qualitative analysis. And here are some of the factors that they considered. So there's a long history of no credit losses for U.S. Treasury securities. So that equates to a historical loss rate of 0%. And then the securities are backed by a sovereign entity that can print its own money. And then they see that the sovereign currency is routinely held by central banks and other major financial institutions. It's used in international commerce, and it's commonly viewed as a reserve currency. So based on their analysis, they determined that this indicates that historical credit loss information could be minimally affected by current conditions and reasonable and supportable forecasts. So thus, they conclude that the Treasury securities don't need an allowance for credit loss. And in the standard, they note that this example is not intended to be an all-inclusive list of factors that you might consider. So it's really up to management judgment what factors you consider in your analysis. And they also specifically note that this example isn't intended to just be applicable to U.S. Treasury securities. So you could possibly apply this method to other types of cash equivalents. And money markets would be a good example because those money markets typically invest in U.S. Treasury securities. So obviously there will be nuances and each cash equivalent will need to be evaluated independently. However, our team has drafted examples of documentation that you can leverage to assist you with implementing CECL for cash equivalents. So now we'll get into the details of ASC 326-20, which houses the main current expected credit loss or CECL model. So keep in mind that this same credit loss model applies to all the assets on the slide that Elad shared with us earlier, including, for example, financial assets such as trade accounts receivable, loans, notes receivable, held to maturity debt securities, and off-balance sheet credit exposures. So, of course, there will be some nuances and different things that you need to consider when applying the model to different types of assets. But it is this one credit loss model that's being applied to all these different types of assets. And the one exception being, as Elad pointed out earlier, available for sale debt securities, which has its own credit loss model in ASC 326-30. So this slide summarizes the main steps to implementing CECL. So first, you need to pool your financial assets into groups that share similar risk characteristics. And then historical loss experience provides the starting point for the CECL model. So you then need to calculate the historical loss rate for each of your pools. And then finally, you need to adjust for current conditions and reasonable and supportable forecasts, which may also include reverting to the historical loss rate for any periods that extend beyond the reasonable and supportable forecast period. And we'll go over each of these in more detail. So the first step is pooling. Pooling is required under the new CECL model, whereas it was only permitted in previous GAAP. And then financial assets must be pooled into groups that share similar risk characteristics. So a few things to keep in mind. It's possible to only have one pool if management deems that financial assets are homogeneous in their risk characteristics. And interpretive guidance indicates that pools should be consistent with an entity's internal policies for monitoring credit risk. And then items that are unique, as in they do not share similar risk characteristics with any of the pools, should be evaluated independently. So an item could just inherently have risk characteristics that are different, or a common example might be a customer that's in bankruptcy or facing financial hardship. In those instances, those receivable balances should be evaluated independently. So there's a wide variety of potential risk characteristics that an entity could consider when pooling, when identifying their pools. So this slide list provides a list of potential risk characteristics from the standard itself that management could consider when identifying pools. So for example, internal or external credit scores, risk ratings, size, the industry of the borrower, historical or expected credit loss patterns. So as you can see, there's a wide variety of characteristics that can be considered. And then the standard further notes that this is not intended to be an all-inclusive list. So there really will be a lot of management judgment and subjectivity involved in determining pools. So after you determine your pools, the next step is calculating the historical loss rate for each pool of financial assets. Historical credit loss experience generally provides a starting point for an entity's estimation of expected credit losses. So the historical loss data used in the calculation can be external, internal, or a combination of both. And there's no required historical time period to be used in the calculation. So as such, it's left up to management's judgment how many years you want to look back and how many years management deems reasonable and appropriate to look back. So one thing to consider is if you believe the historical period you're considering will be representative of the losses that you expect to see in the future. So for example, if your entity experienced unusually high credit losses in 2020 due to the pandemic, maybe it makes sense to start your historical loss period after your loss rate normalized. And then an entity would calculate the credit loss expense for each pool to determine the historical loss rate. And you'll want to consider if your historical loss data needs to be cleaned. So for example, are there expense line items in the data that aren't related to credit loss, such as returns or discounts that should be excluded from the calculation? And the other thing you'd want to consider is have credit losses been recorded in other general ledger accounts in error. So generally speaking, you just want to make sure that your credit loss data is clean and includes the total population of losses for the period that you've selected. And then the standard notes that the allowance for credit loss may be determined using various methods. And it lists these methods shown on the slide as examples, which leaves the door open for other methods to potentially be used. However, these will most likely be the most widely used methods as they are noted in the standard. So the discounted cash flow method compares an asset's amortized cost basis with the present value of the estimated future principal and interest cash flows. And then the loss rate method calculates impairment by using an estimated loss rate and multiplying it by the asset's amortized cost as of the reporting date. The roll rate method uses historical trends and credit quality indicators to project expected losses. And then the probability of default method calculates impairment by multiplying the probability of default in a given time period by the loss given default, which is the percentage not expected to be collected in the event of a default. And then methods that utilize an aging schedule calculate impairment based on how long a receivable has been outstanding. So this would commonly be used for trade accounts receivable, and the time periods will correlate to the standard aging buckets. So you can see that the standard is clear that entities need to calculate the historical loss rate as a starting point for their calculation of expected credit losses, but they've left the method needed to be used up to management judgment. So if you're a non-financial institution implementing CECL this year, there's a good chance that a simple, efficient approach will provide sufficient accuracy and meet the needs of the users of your financial statements. And the simplest method noted in the standard is the loss rate method. It's the most efficient method and most likely meets the needs of your average private non-financial institution. And we find it can be particularly useful for trade accounts receivable, loans, and notes receivable. And we'll walk through an example of the loss rate method next. And then methods that utilize an aging schedule. This has been a popular method for trade accounts receivable under IFRS, which implemented their own version of the CECL standard earlier. And this could be a good option if your entity has historically used this method, or if you have an accounting system that can generate reports calculating historical loss rates by aging bucket. We've also found that the probability of default method is useful for held to maturity debt securities. So private entities that aren't financial institutions most likely don't have sufficient internal loss data to do a meaningful historical analysis, in which case external data can be used with the probability of default method. And Elad will share more details on this later on in the presentation. And also important to note, entities may apply different estimation methods to different groups of financial assets. So here's an example of calculating the historical loss rate using the loss rate method. Now, keep in mind, this is only calculating the historical loss rate. We will still need to consider how we're going to adjust for current conditions and future forecasts after this. So we're taking the annual net write-offs for each year, which would include write-offs net of any recoveries for that year. And then we're dividing it by the average accounts receivable balance for the year. And then the average net write-offs is divided by the average annual receivable balance, which gives you the loss rate for the year. And then the average of the annual loss rates from our analysis is the average annual loss rate of 1.3%. And then we'll just take our accounts receivable balance at the year end times the average annual loss rate we calculated, and that will be our estimated expected credit loss. So remember, it's up to management judgment how many years you want to go back to calculate the historical loss rate. You don't need to use 4 years. There's no prescribed number of years. And then if you do have more than one pool, you'll need to complete this calculation for each of those pools. So the next step is to adjust for current conditions and future forecasts, since the historical experience may not fully reflect your expectations for the future. So you will need to adjust for asset-specific risk characteristics as well as macroeconomic conditions. And this section of the standard on the screen, it gives a full list of factors to consider and acknowledges that other factors may apply. And then another thing to keep in mind is that non-credit related adjustments such as returns and discounts, et cetera, should not be considered for CECL purposes. So let's first discuss adjustments for asset-specific risk characteristics. So entities need to consider if adjustments need to be made to the historical loss rate for differences in current asset-specific risk characteristics, such as differences in underwriting standards, portfolio mix, or asset term. So for example, if you were making loans to riskier customers during the historical period and you've since tightened your underwriting standards such that your current pool of loans is less risky, you would want to adjust for that. Or in the context of accounts receivable, consider if the composition of trade receivables at the reporting date is consistent with that used in the historical period. So that is, have the risk characteristics of the company's customers and its credit practices changed significantly over time, such that an adjustment should be made to the loss rate to account for that. But it also could be that risk characteristics have been consistent over time, and then in that case, no adjustment would be necessary. And then you will also need to adjust your historical loss rate for current economic conditions and management's expectations for future conditions. And this is really as simple as selecting a macroeconomic variable that you believe is most relevant to your entity and that in your judgment would have the greatest impact on the future collectibility of your financial assets in scope. And then you compare what the current conditions and reasonable and supportable forecasts are for that variable relative to the conditions that existed over the historical period. Also, the adjustment may be quantitative or qualitative in nature, so you don't need to try to calculate what the correlation is between that macroeconomic variable and the collectibility of your receivables. You are able to judgmentally make a qualitative adjustment based on your analysis of the macroeconomic conditions. And so this is basically, it's just comparing the conditions that existed during the historical period to what it is currently and where you expect it to go in the future. And then you can use your judgment to qualitatively make a percentage adjustment to the allowance for credit losses based on what you think the impact of that will be. You'll want to make sure your research, thought process, and reasoning is fully documented. And the templates that our team has created will walk you through the relevant pieces of the standard and ensure you're documenting management's approach and thought process. So in terms of the macroeconomic variables, so some of the most common macroeconomic variables used in the standard are the unemployment rate and real estate values, but you're not limited to these. Businesses selling to other businesses could consider using the cost of capital or interest rates. So a higher cost of capital may result in businesses needing more additional capital to fund their operations. And then they might prioritize using their money to fund operations, whereas your receivable balance may become a lower priority for them. And then if you have a business selling directly to consumers, then the unemployment rate might be a direct measure of their ability to pay you. But you're not limited to these. Management could elect to use a more specific, tailored macroeconomic variable. For instance, construction, housing starts, real estate values, ISM, manufacturing index. So it's really up to management's judgment which variables you believe are most relevant to the collectibility of your balances. And you could select more than one to analyze if you'd like, but you can also select only one. So let's go back to our loss rate example that we were working on earlier. So we had calculated a historical loss rate of 1.3%. So let's say that they sell to other businesses and they believe the cost of capital or interest rate is the macroeconomic variable that they believe would be most significantly impact the future collectibility of their receivable balances. So for example, let's say they believe forecasting out 1 year is sufficient because short-term AR is short-term in nature, and they can make a reasonable and supportable forecast over 1 year. So they won't need to worry about reverting back to the historical rate. So they do some research and they see that interest rates are currently higher than they were during the historical period and are expected to increase further. So in management's judgment, they decide to make a qualitative adjustment to their historical loss rate of 10 basis points to account for the current and expected increase in interest rates. So now their adjusted loss rate is 1.4%, and their estimated credit loss has increased to $210,000. Then let's discuss the reversion to historical. So entities should only adjust the historical loss information for existing economic conditions or expectations of future economic conditions for periods that are within their reasonable and supportable forecasts. So keep in mind, if you have a short-term asset like accounts receivable, you should be able to forecast out that far, and then you won't need to worry about reverting to the historical rate. However, if you have a longer-term asset like a 10-year loan or debt securities, you may not be able to make a forecast out that far that you would consider reasonable and supportable. And then you'll need to figure out how you're going to revert back to the historical loss rate for that remaining time period. So per the standard, you can revert to the historical loss rate immediately on a straight line basis or using another rational or systematic basis. So reverting back immediately is the easiest option, but it can be a little confusing in theory. So when you think about the adjustment you've made for your future forecast, which we'll say is 2 years, think about that adjustment as just applying the impact of that forecast on only those 2 years with no impact on any of the following years in your time period. So by making no further adjustments to the loss rate, you are essentially reverting back to the historical loss rate for the remaining years. So let's look at an example of immediate reversion. This example is straight out of ASC 326 and will be a good recap of the entire process as well. So this slide is a summary, but you can refer back to this section of the codification for full details. So we have a community bank with a portfolio of 10-year loans that they pulled together based on similar risk characteristics. And although it's a bank, this example is really relevant to any entity. So they're using the loss rate method, and they believe its most recent 10-year period is a reasonable period on which to base its expected credit loss rate calculation after considering the underwriting standards and contractual terms for loans that existed over the historical period in comparison with their current portfolio. So they've looked back over a historical 10-year period and calculated a historical loss rate of lifetime credit loss rate of 1.5%. So 1.5% is a lifetime credit loss rate that they're going to apply to that pool of loans. They considered whether adjustments needed to be made for any changes of an asset-specific risk characteristics and determined that none were needed. But now they're going to adjust for current conditions in their forecast. So for the forecast, they've considered future expectations for real estate values and unemployment rate because they believe these are the significant factors that could affect the collectability of their loans. So they observe that real estate values in their community have decreased as of the current reporting date, and they expect them to continue to decrease over the next 1 to 2 years. They also observe that the unemployment rate has increased as of the current reporting date and is expected to continue to increase over the next 1 to 2 years. So both of these factors would have a negative impact on their expected collectability. So management, in their judgment, decides to increase their expected credit loss rate by 10 basis points due to the decrease in real estate values and 5 basis points due to the increase in the unemployment rate. So now the 15 basis points is added to the 1.5% loss rate they calculated earlier, and this serves as the new expected credit loss rate of 1.65%. And then towards the bottom of the slide, they state that no further reversion adjustments are needed because the bank has applied a 1.65% loss rate where it has immediately reverted into historical losses reflective of the contractual term. This approach reflects an immediate reversion technique for the loss rate method. I'll give you a moment to answer polling question number 2, and then I'll hand it over to Elad to share more details regarding applying the model to held-to-maturity debt securities.
Thank you, Cindy. Great job summarizing a very complex model. I'm sure that was very useful to all our viewers. So next up, I'd like to chat about held-to-maturity debt securities. And the reason we set this one up for discussion is when it comes to investments on for-profit companies, these are the types of investments we typically see in our experience. So investments in debt securities should only be classified as held-to-maturity investments if the entity has the positive intent and the ability to hold those securities till maturity. These type of investments are measured and reported at amortized cost, and as a result, they are subject to CECL since they're not held at fair value. Under legacy GAAP, these held-to-maturity debt securities were considered impaired when the fair value of the investment was deemed to be less than the amortized cost basis, and as a result, an impairment loss was recorded. Now, that's legacy GAAP, which is now replaced by the CECL model. So you can use, under the CECL model, when applying it to held-to-maturity debt securities, you can actually use any of the approaches Cindy went over earlier to calculate historical losses. However, we do have our specific recommendations for held-to-maturity debt securities, which I will get to now. It is unlikely that a private company or non-financial institution, for that matter, will have enough debt securities on hand or sufficient historical loss data to complete a meaningful calculation of the loss rate using the historical loss rate method, or in fact have any access to information required to be able to complete a meaningful discounted cash flow method, which would be the second method Cindy discussed earlier. For that reason, our recommendation actually would be to use the probability of default method, which kind of leverages default data based on credit ratings of various securities that can actually be found online on websites such as Moody's. And when we look at these default rates that are assigned to different categories of investments at specific credit ratings, those can reflect both the historical and current conditions in estimating our credit losses for those securities. And remember, when applying this model, one should not just apply it to all the held to maturity investments at once. Pooling is required, as we discussed earlier. And in this case, pooling could be divided between corporate bonds, municipal bonds, treasury securities. But also inherently, when we apply default data based on credit ratings, that in itself can be considered pooling, as we use different loss data to each security based on its own credit risk. So we've talked about current, historical, and current conditions for held to maturity debt securities, but now we have to go back to the future and consider reasonable and supportable forecasts. Now, obviously, these may not be readily determinable. However, management is still not precluded from considering future economic scenarios when calculating credit losses on held to maturity debt securities. Similar to Cindy's walkthrough of AR, however, qualitative adjustments can be made on supportable and relevant forecasted economic factors. And again, past the points of past the point of the availability of reasonable and supportable forecasts, we may conduct the immediate reversion method, which Cindy mentioned earlier. And the term that we want to look into with respect to these securities can typically align itself with the term of the individual security. So if we're holding long-term debt securities, let's say for 5 years, we may want to consider a 5-year term. If 4 years have already passed, then we only need to forecast 1 year. But if we have to forecast 5 years, because we have 5 years left on the security and we're holding it till maturity, we may only be able to reasonably determine utilize forecasted information for 1 year, at which point we'll revert back to historical losses. So that's pretty much our recommendation for assessing expected credit losses for held to maturity debt securities. Another important note, though, is that expected credit losses can be zero. And this is typically the case for U.S. Treasury bills or other mortgage-backed securities issued by the government. And the reason is that these securities are typically considered risk-free. And for that reason, ACL, or the allowance for credit losses, is not necessarily required. So now that we've discussed these matters and the CECL models and the implication on various assets, let's move on to some presentation matters. So first off, we'll start with the face of the financial statements. And that will begin with the balance sheet. So the allowance must be presented on the face of the balance sheet in one of two ways. It could be stated as a deduction from the asset's amortized cost basis as a separate line item, or it can be disclosed together and as shown as net. And frankly, this is quite similar, nearly identical to the current method of presentation. You either separate it or have them stated together as an offset. So previously, we've seen AR, net of allowance for doubtful accounts, on the balance sheet. This time around, we can see AR, net of the allowance for credit losses, on the balance sheet. And next up, we have the income statement and the statement of cash flow. And the only presentation impact there is that now bad debt expense is replaced with new terminology being credit loss expense. The big piece, however, when it comes to CECL and presentation matters are the disclosures, as CECL brings with it an expanded list of required disclosures. Some of these disclosures are boilerplate, while others are specific to the securities a company or an organization has on hand. Now, these disclosures are summarized in this slide, and they can be quite voluminous. If an entity, however, has adopted CECL, you guys are going to love this, so hear me out. If you adopted CECL and concluded that the allowance for credit losses is not material to the financial statement, it is still reasonable to forego some of these disclosures, so long as management also discloses that CECL has been adopted and is deemed to not have a material impact on the financial statements. Hence, inherently, any of the related disclosures will not be deemed material to the users of the financial statements either. Please note, though, that in the case that it is material and disclosures are going to be required, GHA will not leave you to your own devices when it comes to determining the appropriate disclosures. We do have an extensive library of disclosures that can be tailored to our clients' unique situations. So with saying that, I'll now pass it on to Cindy to discuss some of management's responsibilities while implementing the new standard.
Thank you, Elad. So in terms of management responsibilities, management has a responsibility for developing, maintaining, and documenting a systematic, disciplined, and consistently applied process for determining the allowance for credit loss in accordance with GAAP. So to fulfill that responsibility, management is expected to design, document, and implement policies, procedures, internal controls, systems, and models that result in the development of management's best estimate of the allowance for credit loss. And the templates we've created for clients will walk you through the relevant pieces of the standard and will aid you in thinking through what your entity's approach will be and help you document that. And it's important to note your approach should be consistent year over year going forward. So maybe there will be a legitimate reason to change your approach in future years, but generally speaking, you'll want your approach to be consistent each year. So you don't want to be pooling your assets one way one year and then a different way the next, for example, or switching between macroeconomic variables each year. You'll want to keep your approach consistent. And it's also important to consider that in some cases, the credit loss data used in your calculation may not have previously been subject to internal controls. So management may need to address these challenges and update an entity's internal controls and procedures to ensure the availability of complete and accurate data. So in terms of resources, we've created a number of resources to help you navigate implementation and not feel overwhelmed by this new standard. So this slide includes links to our published blog posts offering supplementary background information on the new standard. We've also included a link to a CECL practice aid that the ASCPA put out, and there's a link to the standard itself. And as noted on the bottom, our team has created various templates for the various assets and scope that are designed to streamline implementation and make the process as easy as possible for you. Each template will walk you through the considerations in the standard and as well as the calculation that needs to be performed. So you can reach out to the GHJ professionals on your engagement team, and they will be happy to provide those templates to you and walk you through them in additional detail. And we've also drafted templates for the various disclosures, so we have you covered there as well. We'll give everyone a moment to answer polling question number 3. And then I'll hand it off to Yulia to kick off the Q&A portion of the training session.
Perfect. Thank you, Cindy. Great presentation, Elad and Cindy. A lot of useful information. Cindy, we see your screen right now. I don't know if you mean to share. It's a beautiful picture from Ireland. We're all very jealous of Cindy going over there. We did have quite a lot of questions that came in during the last hour, and so we'll try to get through as many as we can right now. The question that comes up very often, and the one we'll get started with is the following. So here's how it usually goes. So people normally say, my company has had historically very material bad debt write-offs. It's never been an issue. Do we really have to go through the implementation effort, and are we really required to look into this? And Cindy, I'll ask you that first.
Thank you, Yulia. I'll kick that one off. That's a great question. It's probably a question on the minds of at least a few other people in the audience, I'm guessing. So I would say that with the new standard, it's a little bit harder to justify not having an allowance if you have a material balance of AR, for example, or any other asset and scope relative to what it was under the old standard. So at a minimum, you would need to perform that calculation to prove out that you've historically had an immaterial amount of credit loss. And then if that truly is the case, we might be able to perform more limited procedures, but at the very least, you'll need to perform that calculation, which we saw was relatively easy. And the other thing to consider is that those of you who are familiar with audits is if it could possibly pass the threshold for a proposed adjustment. So that's something else that we would need to consider from an audit perspective.
Great, thank you, Cindy. Elad, any additional thoughts on this?
Yeah, great question. Cindy covered it pretty well. Let me answer it from an auditor's perspective. Just because management deems something to be immaterial, there's always a risk that it could be material. So as auditors, we're going to want to go in and actually ensure that you conducted the exercise reasonably and that your conclusion is reasonable. We'll want to prove out that it's indeed immaterial. In subsequent years, we can apply analytics or something of that sort. But in this first year of implementation, we'll want to make sure that the exercise is conducted and that we can conclude that it is indeed immaterial. You may result in not having the actual allowance on the books, but the work to support that will still have to be conducted.
Absolutely. As usual with the accounting standards, it may not result in any significant changes, but you do have to do the work to get to that point. Another question that came in, and I'll probably ask you a lot to weigh in on this one because I know you've researched this for a client. For loans secured by collateral, does the new standard take that collateral into consideration when determining the appropriate allowance for the loan?
That's quite interesting. And we worked on that one together. So you can definitely leverage off that the fact that there is collateral when calculating your ACL. But what you shouldn't do is completely not calculate it because there is collateral. You'd want to assess, first off, the fair value of the collateral. Is it sufficient to offset the risk of uncollectability? But also really the liquidity associated with that collateral. And I would say the volatility in value with respect to that collateral. And the reason you have to consider those two things is depending on how long it can take you to liquidate that collateral, the value may change substantially. So does it actually offset completely the credit loss that you have? It may not, but that assessment needs to be conducted. So I would say yes, and it can be considered, it should be considered, but it does not preclude one from making that assessment in the first place.
Lots of complexities, lots of things to consider. Cindy, a question for you that came in. We talk a lot about credit loss, an allowance for credit losses. What about credit gain? Could there be a credit gain?
Yeah, so that's a great question. It is possible to have to calculate an allowance that would actually be like negative and added to the balance of your receivable balance. So if, for example, if you have a large recovery of a balance that was previously written off in previous years, that it would be theoretically possible. I think it would be kind of unusual, but it's theoretically possible. Or also, what could it be a factor is if you expect your macroeconomic variables in the future to impact your allowance in a positive way. That could be another thing that could result in having an allowance you actually add to the balance of the receivable. But again, like you're only making a small adjustment. So I think it would be kind of rare, but it is theoretically possible.
Interesting. So that goes against our very nature on conservative accounting when now you're recording gains. Another question that came in, and I think this one comes a lot with auditors or management with private companies or nonprofits. A lot of guidance that comes out from FASB deals with extensive disclosures, but some of them are limited to public companies. What about disclosures that cover all entities? So let's say year-to-date changes in allowance for credit losses. Do private companies and nonprofits, are they required to also disclose that? Elad, I'll ask you, since that is what you covered.
Yeah, and I kept that summary of disclosures succinct in order not to bore everyone on the webinar. But that is a great question because one of the more significant disclosures that now have to be included on the financial statement is actually a roll forward of the credit loss allowance, which would include any additions or deductions to that allowance balance. So that disclosure in it by itself will encompass all the movement and activity for the year. And it's essentially the same requirement for private companies as public companies in that case.
Mm. So, but again, I think I heard you mention too, if it's not material, there is that leeway
Oh,
to
of course. Materiality is always our friend. And again, if there is no, my recommendation is going to be as follows. If there's no allowance recorded, because collectability is not an issue, was not deemed to be material, at the very least, what companies will want to disclose is that CECL has been adopted, and as a result of implementation, there was no material impact to the financial statements. And by saying that, you know, inherently nothing else related to CECL will be material. So you can forego those disclosures. But if you do have an allowance recorded, whether or not it's material and it's actually on the face of your financial statements, I would highly recommend that those disclosures be included. We want to make sure we're being consistent. You know, if something is on the financial statements, we want to make, regardless of materiality, we want to make sure that all the corresponding disclosures are included. But short answer is yes, you can consider materiality when determining whether or not to include that on your financials.
Yeah, absolutely. Right. Another question came in, and I think sometimes we struggle a little bit with the fact that accounting guidance have been transitioning to principle-based standards. So a lot of standards that have been issued over the past several years are more principle-based, and so this one is in particular is very judgmental, as both of you, I believe, mentioned during the past hour. So let's say management performs the analysis of credit losses and say there's no additional risk, there is no reason to change the loss rate, none of it. You know, it's really, they don't feel that there is an additional risk that would adjust the allowance for credit losses. Would that be sufficient? Cindy, I'll ask you to weigh in first.
Yes, thank you. Yeah, that's a great question. And none of our examples in the presentation included examples where there was no adjustments, just because we were trying to keep it interesting and show good examples. But it is possible that you'd have no adjustments. So you need to first look at your asset specific risk characteristics and think about whether they've been consistent over time. And you want to make sure that's documented. And then the other piece of it would be the macroeconomic variables. So if you've selected macroeconomic variables that you believe are the most relevant to the collectability, and you look at those macroeconomic variables and you do an analysis and you determine that they've been consistent over the historical time period and currently, and you expect them to be consistent in the future, then you would theoretically have no adjustment to the historical loss rate. But again, you want to make sure that that's, well documented and that your analysis that you did, the research you did is what is documented to support them.
Yeah, absolutely. We probably have time for one more question. So Elad, I'll pose this one to you, as I know you work on a lot of international entities and the different gap methodologies. So is the CECL standard, the CECL standard we've been discussing today is US specific, but is there a similar guidance in the international gap, for example, German or others?
Yeah, so let's actually break that out. So when we're dealing with international companies, there are different reporting standards. So internationally, let's look at IFRS, which is the big one. IFRS beat US GAAP to the punch. A few years ago, they actually instituted their new accounting policy with respect to financial assets, which is pretty comparable to ours being CECL, and they call it, I believe it's called IAS 9. And what I can say in my experience that companies that implemented IAS 9, in fact, use that aging method, which was one of the methods Cindy mentioned earlier. So it is impactful to international companies that utilize IFRS. With respect to some of the others, and you mentioned Germany, I'm not a German GAAP expert, but I do have some experience working with companies that report to German parents and follow German GAAP. What I can say about German GAAP is that it's less robust than IFRS and US GAAP. And my understanding is that currently there isn't an equivalent standard in place. But then again, you know, you'd have to consider impairment of assets and so forth anyways. So that was a pretty good question.
Interesting. All right. Well, I think that is all the time we have for today. I'd like to thank Elad and Cindy for sharing their expertise with us. And thank you to all the participants as well for your engagement and the great questions that came in. For any questions we didn't get to answer live, we will follow up with you with an email. And if you have any additional questions, you have your experts here on the screen, Cindy and Elad. Please feel free to reach out. Your CPA certificates will be emailed after the webcast as well. And finally, we'd love to ask you to spend just a couple of minutes of your time to complete an evaluation that will be sent out after this webcast, as we always are looking for feedback and looking for ways to improve. Thank you, everyone, for your time.
Thank you.
Thank you.